Today I'm going to talk about inflation. What is the real rate of inflation? There are two numbers that are out there. Is it 4% or is it 12%? Or maybe is it something in between? Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Tuesday, July 11th, 2023. I'm going to tackle this subject more than just inflation. I'm going to kind of tackle the subject of where do you get your data from and how much do you believe in that data? Do you look at conventional sources for your information, not just inflation, but everything in life? Or do you look at that and say, you scratch your head and think, I'm not sure I really believe everything I'm being told. And then you drift over to alternative sources. Do you seek those sources? And what makes the difference between the two? I find that most people are one or the other, maybe some version of both, but usually most people are thinking they buy their information mentally, buy it from conventional sources. That could be the government, it could be big pharma, it could be media, it could be a variety, it could be financial, banks, the whole financial industry, etc. From all aspects of life. Everyone is promoting data that supports a conclusion. Is there an agenda or a hidden agenda in what they promote, and how credible is it? When you get to inflation, that's what we're talking about. The government, Bureau of Labor Statistics, which is in the Department of Commerce, they have been promoting the Consumer Price Index for decades and saying, and it is normally equated with the rate of inflation. So when you say CPI, Consumer Price Index, inflation, those are generally viewed by the media and are promoted by the media as synonymous. And so many people have become accustomed to buying that and thinking that's what it is. When you get to this, there are two alternative sources. One I'm going to show you is the Chapwood Index, and that's a more recent index. I don't know how long it's been out. I think quite a while, but many years, but not decades and decades, I don't think. And there is the ShadowStats. Now, ShadowStats has been out since about 1980. And of course, this goes before the internet. But they were, I think, doing paper newsletters back then. But the data has been collected for 40 plus years. And so what John Williams has done, who's the owner of ShadowStats, he has been publishing white papers and documenting as an economist the actual rate of inflation compared to what the government promotes, and his data is represented by the blue line. The red line represents what the government has been promoting, what they publish in the CPI, Consumer Price Index. As time has gone on for these 43 years, those lines have diverged, and you can see the difference. The government, Bureau of Labor Statistics, and they put this on their website, is that they exclude certain items, namely food and energy. And then they do substitution. It's a methodology, and they've been doing this since, I believe that when I read about this, I believe it's in the early 90s, they've been doing substitution. And what that means is, when an item from one year to the next in a 12-month period goes up a certain percentage, if that is not the number they're looking for, they find a similar item of lesser quality and substitute it so that the change from one year to the next achieves their desired result. The desired result is a 2% rate of inflation over time on average. Now you see from either line, let's just say the red line, you see that it goes up and down, but when you cut right through all the data, the number, hopefully, they believe is 2%. So they use 2%. Now that goes over into the financial planning industry and the financial advising industry. They enthusiastically support the proposition that inflation is 2%. They'll say it over and over and over. Why? Hidden agenda. If their investment portfolio does not keep up with the real rate of inflation, you're going backwards in buying power. And so by using a 2% number, that's a pretty low bar for getting investment results that are better than 2%. Most financial advisors can do that. But if it got much higher, it gets harder and harder for them to do over time. So they love that 2% number. And of course, the media, who caters to the financial industry, they do the same thing. They use 2%. But you know, and I know, when we look at the price of anything, call it the price of a car or a house or clothing or a meal or anything at the grocery store, utilities, insurance, everything that we buy, we look at that and we know it's not 2%. And so even when it went up recently, it still fell way short of what people were actually experiencing. So the question is, where do you get your data from and how much do you believe it? I find that there are people who kind of fall into the camp of they believe what they're being told. So they believe in big government. They believe in big pharma, big media, big banks, big financial institutions. In general, if that's being told, they believe that. There, I believe, are millions, tens of millions of people who believe that way. Now, they won't say it that way, but when you look at how they live their lives, to me, it kind of translates to that's kind of how they look at the world. There are other people who are skeptical of that. They've seen too many examples where that's just not true. And so they look for other sources of information. Or maybe they just discredit it and they don't look for other information. I'm in the latter camp. I look for other information. So I tend to look for alternative sources. Now, I want those sources to be credible, and I want them to pass the smell test, and I check them out, multiple sources. So I don't just buy something because it's alternative. And but when you get to the financial industry, and you get to the Bureau of Labor Statistics and 2%, I don't believe that. So John Williams, author of ShadowStats, says the blue line says that the rate of inflation is around 12%, the real rate today, around nationally. Each area is different. And so that, and I've shown this before, but that's where it is today. Then I showed 2 weeks ago, I showed the Chapwood Index, which is it's a newer index than ShadowStats. But what I liked about the Chapwood Index is that they take the 500 most commonly purchased items and they rate the change from one year to the next. And they figure the rate of inflation for 500 of the things that people buy mostly. Now, you may not buy all 500, but that's an indicator. But they're not measuring a few groupings. They're measuring a lot of items, and everything from peanut butter to movie tickets. And then they break that down to by city. So they take the 50 largest cities and look at the 500 most commonly purchased items in those cities. It makes sense to me. So I did some research on this, and this is part of my independent thinking, is I I looked at it and I said, I think this makes sense, but I bet everybody doesn't buy it. So I started looking for those who disagree with it, the pros and cons, find out those who are arguing against it, who believe what the government is promoting as a 2% rate of inflation. They're out there. So I found one in particular, the very long paper, and written by an economist, and he was trashing both of these, the Chapwood and the ShadowStats, and I could tell he's kind of a big government guy. I mean, he won't say it that way, but he believes in whatever big government is promoting is what he's going to buy, and he was vehemently, standing firm on 2% inflation and Bureau of Labor Statistics. So, and there are critics of ShadowStats. There aren't very many on either one. There are not very many critics, but it comes down to what is your worldview? Do you view the world from you trust the big institutions, whether it be government or business or otherwise, you believe those institutions, or you realize that they have an agenda, sometimes a hidden agenda, and that they are self-serving and they're not necessarily doing what they're doing to protect your best interest. So anyway, I just thought I would bring that up because if you took a more moderate view of this, you would say, and by the way, the Chapwood Index comes up with about a 12% number as well. Theirs is more of a bottom-up approach, and I think ShadowStats is more of a top-down approach, but they both end up at about 12%. I thought that was so interesting. But if you don't believe that, maybe you could say the real rate of inflation is somewhere between the two. Maybe it's not 12. Maybe it's 8 or 10. Well, if you think it's anywhere between anything like that, 7, 8% or higher, you are believing something that shatters the world of the financial industry, shatters their world, that whole system of what they're doing, the way they invest, the risks that they take, how they promote their methodology, the planning that they do for people on how long your money is going to last you, the buying power of the dollar. All of that collapses if you believe anything that starts to approach that 12% number. But so anyway, I just thought I would share all of this with you because it's front and center, because there are rate increases that the Federal Reserve is doing. We'll get into that, or not doing, and they are trying to deal with this issue of inflation. And so if inflation is high and they're trying to get it down to 2%, right now they're saying it's about 4% CPI. So if it's at 4, we know it's not 4, but if it's at 4, then they've got 2% to go, and that last 2% is going to be hard to achieve, I think. So then they say they've got 2 more rate increases to go, at least 2 more rate increases. So what this does, the implications of this, is that if they do this is why they're holding off right now, because they know the economy is fragile. And if they do that, you stand the risk of a hard landing or crashing the economy. If you do that, then you've got probably a bond market collapsing further and a stock market collapsing, at least for a while. And I don't mean 50%, but I'd say at least 10 to 15% probably, some kind of a correction in the market. So they're trying to avoid the economic shock waves and the stock and bond market shock waves. That's why they're going easy right now. So that's why these things matter, because if it's really 12%, and what are they going to do? Get it down to 10? I mean, it's not workable. But they're not going to believe 10 or anything close to 10, because that would be a big reset. That would be a big reset for our economy, both in the U.S. and the world, in my opinion. Okay, I'm going to look at, this is the stock market. So this is a 150-year view of the stock market, of the S&P 500. So when you look at this, there are some things going on here. First of all, the blue part, those are symbolized by bull markets, up markets, and then the red are bear markets. Those are market periods of decline. So you can see that there have been 4 periods of deep decline in the stock market in 150 years. The bookends are bull markets. So there are 5 bull markets here and 4 bear markets. What's next in the cycle, at the very end, I indicated with a red arrow, what's next is a bear market. When does it begin? We don't know. Maybe it has already begun. We will only know in retrospect. But we can see that black regression line cutting through the data, through the chart, and look how far we are above the regression line. And then when we see how far down these collapses happen, look how far down we've got to go whenever the market actually collapses. And the reason I cover this, it's so important because it's important to people who are investors, people who have money in the market, whether it's the stock market or the bond market. They are counting on that money for their retirement, or they are in retirement and they cannot afford to lose it or lose half of it or a significant portion of it. But yet when you look at this, that's probably what's coming, at least at some point. It may be a few years away, so I'll give myself some room here. But I would say the further out we go, the bigger the chance is that this is going to come on down. It matters because traditional buy and hold portfolios do not believe in getting out of the market or adjusting portfolios. And if you're in one of those, be careful. Be aware that this is probably what's next. We tactically manage money, so if we work with us, you know we do that. So we will be looking for a place to get out of the market sooner than later. But I'm unwilling to take the ride down the elevator. I'll just say it that way. But this is it's an important chart, I think, to just show you the high end of the chart, the low end of the chart, and the regression line to see where we are in the context of history. And by the way, this is a logarithmic chart. Okay, for the last week, I'll say the last 5 days actually, Tuesday was a holiday, the 4th of July. So from Friday, Monday, Wednesday, Thursday, and Friday, those 5 days, you can see this is the pattern of the market. A couple of up days and some down days. What that looks like on a larger chart, when you push it out for the last year, you can see actually back to the beginning of the year, so about 6 months, you can see, I circled in red, you can see where we are today in the context of the last 6 months. The market's up, but you're beginning to see a pullback. The S&P is up about 15% for that time period, but look at the data down below. That lower part of the chart is volume. Volume matters. So when there is elevated volume, it shows that the market is taking off or it's collapsing. It's moving in one direction or the other. You can see there's a 50-day moving average line that cuts through that data at the bottom of the chart, and you can see that we are 14.8% below the 50-day moving average. So the market, the volume is anemic, fairly anemic, and it is it's not indicating enthusiasm. So I would say the market right now, it looks like it has more downside risk on it than upside opportunity. Okay, Joe Kernan at CNBC is interviewing Jason Tennert, the chairman of Strategus, and I'm going to play about a minute clip from him, and he says that we may not see a new high in the S&P 500. Remember that chart I just showed you? We may not see a new high for 2 to 3 years from now. What he's implying when he says that is that the market is going down for some period of time, probably attempt to go up, go on back down, etc., for a period of 2 to 3 years before we get back to where we are right now. Anyway, he makes a case for that. And at a minimum, he says, it's going to be hard to get new gains from here. Important thing to not just hear happy talk, but to listen to somebody who's credible, who's heading a research firm, and what he has to say about it. So take a listen to Jason Tennert and Joe Kernan.
Joining us now, Jason Tennert, Chairman and CEO of Strategus Research Partners, a Baird company. Started coming around a little bit, Jason. Number one, I feel your pain. I understand that things weren't all set up for a big move higher in the NASDAQ. There are a lot of reasons. We had a guy on say that he didn't really feel like he was wrong being negative on the NASDAQ. He just felt like the strength of his arguments were so good that his clients should respect him for the strength of his arguments, even though he's dead wrong. But now that we've gotten where we are, you can't go bullish now.
No,
right?
and I'm not.
And people have been on saying, we may not see, this is just last week, we may not see, or maybe it was Monday, all running together, we may not see a new high out of this trading range, a new all-time high in the S&P for 2 or 3 years from now.
Listen, from a valuation perspective, it's very hard to make the case that you're going to see a new high, and it's frankly very hard to make the case that you should be at the levels that you're seeing right now, especially if you have our economic view. In our shop, we start with kind of a macro view and then move out from there.
Okay, next is a chart, kind of makes the same point. This is a data chart from Crestmont Research. And this shows, this is projections of where, based on historical patterns going back to 1909, where are we, what are the deciles, the 10-year period of where we're looking forward, what is the first decile, the second, the third, fourth, etc., and the 10th. The 10th being the very best picture, the most optimistic view looking forward, and the first decile being the worst decile, the worst 10%. We are in the first decile. So it looks like from this chart, the estimation is that we will have the total return of the S&P 500 for the next 10 years is projected to be minus 1.8 negative to a positive 3.6%. The average is 1.3. So let's assume that the government is right and that the average inflation rate is 2%, and that happens to be the rate of inflation for the next 10 years. It may or may not be. But if it is, then we're going to experience a decline in the market and a decline in the buying power of the dollar relative to the S&P 500. What this assumes is that the average beginning PE ratio for this decile is 27 to 1, price to earnings ratio. And the average ending price to earnings ratio is 14.8. That is a bad picture from where we are today. If you look all the way down to the bottom, you'd say those are very favorable pictures. Wouldn't it be nice to think that we would have a rate of increase for the next 10 years of 16 to 19%, and that we would be beginning, which would be required actually, begin with about an 11% price to earnings ratio. Wow, that would be a nice picture. But that's not the way that it is right now. This is a chart also of data. There are, I believe there's 14 metrics, 14 or 16 metrics here that to measure the valuation of the market. The second one is the price to earnings ratio. And this shows that we are we undervalued, extremely undervalued, average, overvalued, moderately overvalued, or extremely overvalued. The redder it gets, the worse we are. So right now, the PE ratio is 24.7 to 1, price to earnings, way overvalued. So even though we've had a correction last year, the market has gone back up into overvalued territory, which makes it very risky. This is based on data, as you can see in that second line, on data going back to 1926. This tells you that a 24.7 falls in the category of extremely overvalued, and in my opinion, that makes it risky. I'm going to play the next clip from Melissa Lee from CNBC. She's interviewing Mohamed El-Erian, and I like playing Dr. El-Erian because he's very smart. He's full of extremely valuable insights, and he's very direct. He speaks in very few, 10 seconds or 20 seconds, he will give her a very direct answer of the answer to her question. A lot of people don't do that. They kind of beat around the bush and you have to figure out what they're saying, but he's very direct. He says, in essence, that the Fed, who is in charge of the interest rates, regulating interest rates and the economy, basically stimulating or slowing down the economy. He says they are boxed in. He doesn't use the word boxed in, but he implies that. They need to raise rates, but they're afraid to. They were very tepid in their, he said this many, many times. They were slow in getting started and they didn't do enough. They have gone, they delayed doing rate increases. Remember when they were calling inflation transitory? Holding off. That's when they should have been applying it. And he was saying it back then. They need to be raising rates and they're not doing it. Well, now they're boxed in. They've raised rates 10 times. They paused and did not raise rates this month or this past month. But they're in a pickle. So they need to, if they say they want to get inflation or CPI down to 2%, which they hold firm to, Chair Powell says that, then there's going to have to be more increases. Inflation is still stubbornly high. And so, and as such, what this means is the economy is at risk. And I think when you go over into the stock market, although that's different from the economy, I think it puts the stock market more at risk as well.
For his thoughts on this and the markets, let's bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and President at Queen's College at Cambridge University. Mohamed, great to see you. Where did you fall in that survey?
So I think if they are serious about that 2% inflation target, then they should hike. In fact, Chair Powell told us yesterday that a majority of the FOMC expects at least, he used the word at least, 2 more hikes. So if they are serious about 2%, they should hike.
Do you think that they will have to give up 2% in some way or acknowledge that going towards 2% or touching 2% is sufficient? I mean, it seems like, everybody talks about Jackson Hole, but Jackson Hole might be sort of a good time to sort of elaborate on that and expound their views.
So Sarah Eisen asked that question at Centra, and all 3 central bank governors, other than Bank of Japan, so ECB, Fed, and Bank of England, made it very clear they don't want to even talk about it. The problem, Melissa, and we see it in the data on a weekly basis, is that because the Fed was late, inflation has gotten embedded in the service sector, and to get to inflation in the service sector via interest rate, you undermine the goods sector. So that is the trade-off they need to make. They want to maintain optionality right now. That's why they paused at the last meeting. But let's hope that's not the muddled middle, because getting to service inflation is tricky. We saw this again in Europe today. Headline came down, but core went up. And that we are seeing as a repeated message in most of the advanced world.
Finally, I want to play this is on real estate. Now, I say it because it doesn't relate to the stock market, and it's very insightful from the people at Morgan Stanley who are in charge of real estate. It's a category of assets that includes real estate. And the two co-chair, I guess, of that segment of Morgan Stanley, they both do a little piece back and forth. And so it's a couple of minutes of some interesting insights related to housing. New housing, new home sales, existing home sales, demand in the market, et cetera. Anyway, I think you'll find this interesting for a couple of minutes.
Welcome to Thoughts on the Market. I'm Jim Egan, co-head of U.S. Securitized Products Research here at Morgan Stanley.
And I'm Jay Backow, the other co-head of U.S. Securitized Products Research.
And on this episode of the podcast, we'll be discussing the U.S. housing market. It's Thursday, June 29th at 11 a.m. in New York.
All right, Jim. We put out our mid-year outlook about a month ago. And since we put out that outlook, we've had a breadth of housing data. And it feels like you can pick any portion of that housing data, sales, starts, home prices, and it's telling a different story. Which one are we supposed to read?
I think that's a really important point. The U.S. housing market right now is not a monolith, and there are different fundamental drivers going on with each of these characteristics, each of these statistics that are pushing them in different directions. Let's start with new home sales. I think that was the most positive, we could say the strongest print from the past month. The consensus expectation, just to put this in context, was a month-over-month decrease of 1.2%. Instead, we got an increase of 12.2%. To put it succinctly, new home sales are basically the only game in town. Existing listings remain incredibly low. We've talked about affordability deterioration on this podcast. We've talked about the lock-in effect, the fact that the effective mortgage rate for existing homeowners right now is over 3 points below the prevailing mortgage rate. That just means there's no inventory. If you want to buy a home right now, there's a much greater likelihood that it's a new home sale than at any point in the past 10 to 15 years. And new home sales were the only housing statistic in our mid-year forecast where we projected a year-over-year increase in 2023 versus 2022 because of these dynamics.
All right, so that's the new home sales story. Does that mean that we're just broadly speaking supposed to expect more housing activity?
This is the single most frequent question that we've been getting the past 2 weeks because of this data that's come in. And what we want to be careful to do here is not conflate this growth in new home sales with a swelling in demand for housing. As we stated in the outlook, we expect the recovery in housing activity to be more L-shaped. This behavior is apparent in more higher frequency data points. Purchase applications, for instance, 2023 remains far weaker than 2022. Average weekly volumes are down 35% year to date versus last year, and they're really not showing much sign of inflecting higher.
So I think this kind of characterizes Chairman Powell. Of course, he's in a lofty position, and I should be respectful, but it does characterize his actions mostly for the last year and a half. Thank you for watching. If you have comments or questions, leave them in the comment section below. Thank you.